This episode of the What the FinTech podcast is sponsored by Equifax. Hello and welcome to another brand new episode of What the FinTech, the podcast from the team behind FinTech Futures and the Banking Technology magazine. My name is Paul Hindle, Managing Editor of FinTech Futures, and for this episode we're joined by Seth Moran from Equifax. Seth, welcome to the show.
Hey, Paul. Happy to be here. Thanks for having me.
It's great to have you here. And just to get started, would you like to quickly let us know a bit about yourself and your role at Equifax then?
Excellent. Thanks. Yeah, so Seth Moran, I am the SVP and General Manager of our digital banks and strategic markets vertical here at Equifax in the US particularly. That includes also our telco and our digital media spaces. And those sectors, while they sound very discrete and independent of one another, they're very similar in the way they go to market, very digital first. And so I really enjoy engaging with those organizations, and how they go to market actually has more similarities than differences.
Sounds great. And again, great to have you here, and thanks so much for taking the time out to speak with us today. So, on the show this week, we'll be diving into the evolving landscape of fraud and credit risk with a particular focus on the prime and super prime customer segments. In particular, we'll explore how synthetic fraud is exploiting new entry points through deposit accounts, how AI has dramatically lowered the barrier for fraudsters to create sophisticated synthetic identities, and why financial institutions may be struggling to accurately classify losses between fraud and credit risk. We'll also examine how Equifax is helping banks build a more complete view of the customer by integrating fraud and credit risk assessment across the entire lifecycle, and how AI is enabling institutions to drive operational efficiencies while strengthening their defenses. So, to start off with then, Seth, let's start with what you're observing in the market around prime and super prime customer performance. What trends are you seeing in loss ratios for these traditionally low risk segments, and what's your perspective on what's driving these patterns?
Absolutely. And first, Paul, I think it would be helpful just to provide a bit of an overview for Equifax in general, right? So we are a global data analytics and technology company. I think most people think of Equifax as just a core bureau, a credit bureau, and simply put, but I think we're really bigger than a bureau. We've really made a lot of investments over the past several years, particularly a $3 billion investment in Go fully cloud native. We're the first bureau to do that, and also the first data provider of our kind to do that. And it's really giving us an edge in how we look at a holistic view of the customer lifecycle and how we're engaging with banks. Additionally, I think it would be helpful to zoom out and really define synthetic identity, just for those users that might not be as familiar. So synthetic identity is almost always built off of essentially a real piece of PII, usually a social security number here in the US. And then it's spliced together with fake data, either a fake date of birth or burner address, to make what is somewhat of a Frankenstein of a persona. And those synthetic identities are created with the intent of committing financial fraud. And so those synthetic identities typically establish a relationship with a bank, often applying for a very low limit, low risk financial tool or product, whether it's a loan or card. They're usually denied their first time, which is actually the intent. So that's then reported to a credit bureau. The bureau has to do the due diligence of setting up that denial. That is our responsibility to the financial ecosystem. And from there, they wait. And then they'll often open a small account and make payments on that account, look like a normal everyday consumer. And then they'll scale that as time progresses. So they'll scale it to a larger financial product, and then a larger one, and then a larger one. And then eventually they're going to bust out. And what bust out means is they'll max out whatever financial tools or products an institution has provided onto them, and you'll never see them again. So they'll go into a normal collections life cycle, usually going to about 180 days, and then it's written off as bad debt. And it looks like a consumer that's just disappeared. And that's ultimately the goal of the fraudster, and they're on to the next. In fact, Equifax estimates that about 10 to 15%, and this number is growing, of loan or lending write-offs are actually due to synthetic identities. So it's a massive issue in the space, and I think it's something that's continuing to evolve as technologies are evolving as well.
When it comes to how losses are categorized and reported, what challenges do financial institutions face in accurately classifying fraud versus credit risk, and how is Equifax helping banks address this issue?
Yeah, this is a major operational risk, Paul, because synthetic identities obviously appear to be real creditworthy consumers making payments for months, if not years, And then when they finally bust out and leave those financial institutions holding the losses, whether it be past due balances or maxed out cards, et cetera, it's going to go through that normal collections workflow, as I just mentioned. The problem is that while the organization is going to be faced with the financial loss in either scenario, if they're not categorizing it correctly, they're not going to the right frontline defense team to ensure that they're tweaking their risk mitigation processes. So, for example, if it appears to be a real consumer, synthetic identities not captured either at onboarding, and obviously if you've made the loan, you haven't caught that. So during the account management workflow or even after the fact in the collections process, then you're going to just assign it as a credit loss. So then you go to the credit team, worst case scenario, you tighten your credit bands, you get a bit more restrictive, and potentially are saying no to good consumers, even lower tier band in terms of credit worthiness, and foregoing that lifetime value that's often going to a competitor. Instead of going to the fraud defenses and saying, what can we do better? How can we tweak or twist the knob, if you will, to get a bit more sophisticated from a fraud scoring and a fraud mitigation, a fraud monitoring perspective? So that's really the worst case scenario. Equifax is really trying to help address that issue and concern by injecting real-time data decisioning across the asset lifecycle, particularly leveraging differentiated data assets. We've got a telco and utility exchange here in the US, which is unique to Equifax, which actually provides visibility for about 38 million consumers outside the traditional credit file and another 250 million in aggregate. In addition to that, we've got lease to own and rent to own data assets such as DataX, Teletrack. So that really provides an additional depth and breadth in a consumer's lifestyle as well. And then there's other key risk signals that we're leveraging from a device perspective that give us that kind of real-time asset that we can inject both at onboarding and throughout the consumer's journey with you.
When you look at how fraudsters are approaching financial institutions today, what are you seeing in terms of their kind of target entry points?
So I think that it's all of the above, of course, but there's a really, I think, simplistic way that these fraudsters get into a financial institution and kind of use the old cybersecurity method of going horizontal before going vertical. And it's really in the demand deposit accounts. So the DDA, checking and savings account, that is for most financial institutions a wonderful place to start a relationship with a consumer because that creates stickiness. It creates the value immediately, right? So if you're doing checking with an organization, might you then branch out and get your first loan or get your first card or your auto loan and eventually a mortgage? So this is exactly where these fraudsters start. And rightfully so, with the exception of defending fraudsters, there's usually a low friction point to entry in the DDA space. So you want consumers coming on to your deposit accounts and creating that stickiness and direct depositing from their employers. And so when a fraudster goes there, there's usually a low barrier to entry. And then they start really expanding horizontally and then eventually vertically in terms of higher exposure loans or cards, et cetera, because the financial institution lowers its guard. It's this a consumer that's been making active deposits into this account over time, maybe months and years, as I mentioned earlier. And so the organization gets really comfortable with that persona. And so there's probably a fast track in many cases we've seen with working with our partners in underwriting those additional loans or products. So we really advise that financial institutions, banks, telcos alike are looking at that consumer consistently and monitoring risk signals in real time. And while it may seem like a normal consumer that is got normal behavior, that's exactly what a fraudster is trying to appear as, right? So I think those real time throughout the life cycle checks is critical. And I would actually encourage more financial institutions to treat existing known customer new applications as a outsider in some cases. Now, there are ways to do that, reduce the friction that may maintain customer satisfaction and customer experience. And that's where we really come in and help organizations. And that's where we focus.
So how is Equifax's approach to identity validation different across the entire customer lifecycle? So how do you close those side doors to help keep customers protected?
Yeah, I think the classic mistake is financial institutions making identity verification and fraud scoring as a one and done event at onboarding, as I mentioned earlier. So really just doing that. Is Paul who he says he is? Great. All of this information matches. Let's set up an account and then fast tracking them to the other products and services, which is ultimately the goal. for lifetime value. At Equifax, we believe identity verification must be continuous and dynamic across the life cycle. And our architecture uses sophisticated data transformation techniques to orchestrate that seamlessly. So it's across the entire life cycle, across each of the lines of business and products, whether a consumer is opening another checking or savings account, applying for a credit line increase, changing their account details actually can be one that looks extremely normal on the surface, but could be actually making a more robust persona for that fraudster as it progresses in its relationship with you. And so running that real-time risk profiling is necessary. And we actually have a monitoring service in our platform that will do just that. And so measuring those risk signals and what's looking a little bit off that might require a financial institution to re-engage with that consumer and get a bit more clarity, even once you've had an established relationship. So we close those side doors by validating those risk signals, not only at onboarding, but throughout the life cycle and throughout the process. And I think that's really what's so key in ensuring that you're keeping your organization safe from consumers while also rewarding those consumers that are good and have a great relationship with you.
And when it comes to synthetic fraud, then, as we've been talking about over the episodes so far, how has the rise of AI reduced the barrier to entry almost when it comes to building synthetic identities? What does this mean for the fraud landscape in 2026 and beyond?
Yeah, Paul, I think it's probably the most impactful change in this fraud landscape. Historically, building that synthetic identity took a lot of manual labor. As I mentioned, you're going to go steal a piece of PII, like a social, from a child or elderly individual or an incarcerated individual that's got a dormant credit profile. And then you start to build up that identity over time and draft fake utility bills, burner phones, etc. Well, it's really evolved and industrialized in terms of the rise of agentic and generative AI. So fraudsters, one, no longer have to be sophisticated, highly technically inclined coders, but they can be just an average individual with access to large language models and AI tools that can then set an agent off to do as it's instructed with very little code, just written word. And so we're seeing that it's incredibly sophisticated, but doesn't require a high barrier to entry, which I think is really expediting and increasing the rise of these losses and the challenges that fraudsters are bringing to the marketplace. So, I mean, for example, in late 24, I think the Global Compliance Institute reported that about 80% of new account opening fraud was generated by synthetic identity. I can't suggest that number have changed, but what I do believe very strongly through the data we've seen has changed is the frequency in which those new account openings are being committed as synthetic identity fraud. So I think that these AI capabilities, while are extremely impactful to our everyday lives, they're also making it easier for the everyday fraudster or bad actor to gain access. And I think that it's really democratized the ability to break into financial institutions and to defraud them. So I think it again adds more reliance on your tools and systems and signals. And we appreciate the opportunity to partner with the industry to do just that and doing it over time. And quite frankly, while you're focused on customer experience and moving that consumer through the door as fast as possible, not losing sight of the risks that are coming at us every day.
We will talk a little bit more about AI later on. But before that, I wanted to ask, how do you see the relationship between fraud risk and credit risk? Are financial institutions approaching these effectively today? And what opportunity does Equifax see in this space?
I think that the main observation we've had at Equifax, and I've had particularly in the businesses that I support, is viewing them as independent or siloed and viewing them sequentially. So I think that if you think about credit risk, you're trying to determine, can an individual pay me back? What's their propensity to pay me? When you think about fraud, is that individual who they say they are? But there's really an intertwined reliance on them, particularly in this age of AI, in my personal opinion, and also particularly in the digital sales channel, more so than when an individual is in a brick and mortar financial institution. And what I mean by that is, let's say, for example, 5% of 750s go bad or delinquent and eventually write off. But 10x 750s that are synthetic identity actually go bad because obviously they're getting that loan in order to go bad, bust out, and leave you with the balance. But if you're not intertwining your credit and fraud risks, you're potentially saying no at that cutoff to a 749 that has absolutely no fraud risk, absolutely no fraud signals, and could be a good consumer over time. And so what we're doing is dynamically intertwining the two of those through the onboarding lifecycle and creating really with Equifax.ai, Equifax.iq, a decision strategy index that measures what is the propensity that this individual will repay and where will the stress occur? And then also what is their likelihood of being a fraudster and the signals from a step up perspective. If you're viewing them together, you can likely get more comfortable downstream from a credit perspective, knowing that it's not a fraudster and you can maybe open the buy box a bit. But also from a super prime and prime, as we mentioned earlier, fraudsters don't typically steal subprime or don't create subprime credit portfolios. They want the best and the highest so they can defraud you for as much as possible. Being really hyper vigilant in those what otherwise look like attractive customers. So really indexing those two things together, we've seen organizations be really successful with. If viewed in silo, it's a recipe for a challenge.
Excellent. And how does Equifax's approach compare to other options available in the market? Then, what specific advantages does this integrated approach give you that competitors can't replicate?
Yeah, I mean, I think rightfully so. And historically speaking, many fintechs, banks, digital banks, telcos have leveraged really point solutions and stitched together a lot of different products and services from different vendors. And they all have a niche, right? Whether it's document verification specifically or multi-factor authentication, identity verification, et cetera. And all of that is great and should be incorporated in your onboarding and underwriting workflows, but it also creates latency, it creates blind spot and a massive integration overhead for your tech stack. The systems don't talk to each other. So Equifax is really unique in the fact that we've built a fully integrated cloud native ecosystem through an over $3 billion investment over the last several years. Our Equifax cloud transformation now stitches together through what we call a data fabric, over 100 siloed global data sources. Then we have the ability to keep that ecosystem kind of operating in unison in real time. So that underlying differentiated data, including credit data, alternative credit data, and billions of identity signals, whether it be device or verification signals, you pair all that together with patented ML algorithms, and you get an instantaneous and holistic risk decision. So that's what we really believe is the differentiator for us. And we're really seeing a lot of the positive results with our customers post this cloud transformation. We were an industry leader prior to, and now the speed in which we can deliver solutions and also co-innovate with our partners in the industry has just rapidly increased.
Excellent. Switching back to AI then, I mean, with AI becoming obviously more prevalent in financial services, how are you seeing Equifax's clients leverage AI to drive operational efficiencies and cost savings? And what impact is this having on how they manage fraud and credit risk?
I mean, I think AI is a deflationary force in OpEx when used correctly, of course. I mean, there is undoubtedly some variable costs that I think every organization is understanding that AI is not free, and it certainly may allow for a reduction in human minutes, but still comes at a cost. But let's say, largely speaking, it's a OpEx positive. Traditional onboarding systems flagging suspicious applicant, get sent to a manual review, then there's a step up process. Back office teams are calling and checking documents, et cetera. And that's evolved over the years as technology has increased, but now more than ever, having the opportunity to leverage our Equifax.ai capabilities and machine learning scores, our clients are automating those manual queues so that only a very small percentage of those truly have to make it to a manual step up where a human intervenes in the process. Those advanced AI models kind of drive an outstanding 30% lift over legacy predictive scores and solutions than our non-AI models. And we're just getting started. I think that we're learning as we go, and we're really iterating with our customers and co-innovating because we're cognizant that customer experience is everything and reducing friction is also so important. But we are seeing such a warm reception to using these tools in real time and seeing the results as well from an OpEx perspective and directly to the bottom line. So it removes the noise from the queue, and there's banks are drastically slashing operational costs as a result, speeding up time to revenue as well for the consumers that pass all of the necessary fraud checks.
What are you seeing in terms of how different types of institutions are approaching the decision around maybe taking the savings from AI and running leaner or reinvesting in deeper risk management?
It's a fascinating split. I would say that generally speaking, on the fintech side, where capital efficiency and path to profitability are a bit more challenged or scrutinized, or let's just say thinner margins, they're seeing a massive push to use AI to be more lean. So to kind of do what they've always done, but take it to the next level and really operate algorithmically and seamlessly as much as possible. And they're allowing themselves to automate much more quickly, keep headcount low. And as a result, really address that cost of acquisition, which has always been a challenge, I think, for the fintech space relative to the traditional banks and financial institutions. With the mid-tier and larger financial institutions, we see them taking those OpEx savings and then reinvesting them directly and deeper into multi-layered risk management processes. So I think that we'll see the fintech space also adopt that same mentality and then get even better in terms of how they're deploying their technology first go to market. But it's an interesting impasse where the two are almost working in opposite directions because those traditional financial institutions, in some cases, are more bloated or need to evaluate their technology first versus human capital first processes. The fintechs are almost using it to double down on where they're so strong, which is technology first. So it's a fascinating transition period, and we're eager to continue to support both size organizations throughout the process.
Sounds great. And we've spoken a lot about AI, obviously, over the course of the conversation so far. What is Equifax's AI strategy at the moment, and what work are you doing in this space?
Absolutely. So we're heavily invested and heavily focused on what we call Equifax.ai. The one thing that's particularly important to call out, while we have over 400 patents, so really an industry leader in the space. In fact, we were the first credit bureau to file patents relative to AI over a decade ago. The thing that's so critical as it relates to highly regulated data is that it's explainable. So we have invested in what we call explainable AI, XAI. And that is really where we're focusing so much of our time, energy, and attention. Obviously, fraud is typically sits outside of the FCRA, Fair Credit Reporting Act governance. There are interdependencies, as I mentioned earlier, with those decision strategy indexes where you're splicing together fraud and credit data. You've got to ensure that it's matching with the rules and regulations and laws, of course, as well. And then as it relates to AI, it's even more imperative that we can explain why we made a decision. I think many technology companies can go out and say, this is the right decision because we looked backward, we developed a model, and therefore we have a high degree of confidence as to let the AI run and it's going to spit out to the best possible outcome. Well, at Equifax, of course, we've got to be able to explain it to regulators, to the CFPB, to the consumer itself. We have a responsibility to the financial ecosystem. That is our intent and our purpose in this ecosystem is to create fair historical references to a consumer's creditworthiness or business's creditworthiness, and being able to explain that is so critical. So that is kind of where we start every decision from an AI perspective. Is it explainable? And then moving from there to enhance the technology.
And as you look ahead at the fraud and credit risk landscape, then what emerging trends or challenges are you most focused on? Where do you see the industry heading over the next few years?
Yeah, I mentioned it earlier, and I think I'm super hyper focused on the democratization of fraud tools and the ease of access. I think the fact that these sophisticated state-sponsored fraud algorithms are now commercially available to petty criminals on a subscription basis means that the volume of attacks are going to continue to increase at unprecedented levels. And in fact, I think the technology is getting stronger every day. So we have to meet strong AI technology with AI technology from a defense perspective. That is really where we're hyper focused. And then I think that acting or allowing an agent to act on one's behalf and then scaling that tenfold is really where this continuous life cycle of fraud investigation needs to occur. It is going to be extremely difficult, but I think if done in partnership with an organization like Equifax, we want to be there and co-innovate along the way. We're going to learn things. We're going to get things wrong, obviously, on both sides of the fence. How do we continue to iterate and invest, again, allow the industry to be a part of our innovation roadmap as well? But that's really something that's near and dear to our hearts here at Equifax is how do we help learn from missteps in the industry and then innovate to create defenses as well as being extremely confident in the existing full suite of solutions we have. So I think that's really what's on our minds, what keeps us up at night relative to this topic. And I suspect it also, in talking with many of my partners in the industry, is one of the number one focuses, right? And how do we continue to provide best in class customer experience while also mitigating fraud effectively?
Excellent. And to finish off here, then, I mean, if you could give one piece of advice to a chief risk officer or chief digital officer listening to this podcast about how they should be thinking differently about the intersection of fraud, credit, and AI in 2026, what would it be?
I think that the single piece of advice is we have to stop thinking and fighting fraud, modern fraud, in an AI driven environment with legacy weapons and with legacy siloed weapons, niche weapons. I think that if the organization's separating fraud prevention and onboarding and credit management, that's problem number one. And then if there's not a continuous evaluation across the life cycle, that's going to just open up and expose the organization over time. And again, it's not all at once. It's typically, in fact, most fraudsters that are really effective, it's over a period of time once the guard has been let down. And I think that financial institutions certainly know that. But the way in which it's being scaled today with these additional tools is just even more dynamic and much more challenging to stop. So I think breaking down internal silos within the financial institution, fintech, telco, anything is critical. Working together, having those fraud and credit teams working really closely together is imperative. And then using unified cloud-based decision intelligence. And that's what Equifax has been really successful in deploying in the industry and something we're really proud of and we're going to continue to do. And so we're very focused on partnering with the industry to bring our capabilities to bear to then support their ongoing growth, but also risk mitigation efforts.
Thanks again, Seth, for chatting with us today. To close out the podcast, we have our now infamous FinTech jails. This is where we ask for an industry term, buzzword, or trend that you've seen or heard enough of. Or, of course, you can advocate to free one of the previously incarcerated terms. So what would your selection be for this week?
I'm sure the listeners would say, please put AI back in jail because I believe it just came out of jail.
Yes,
but
it did.
I think rightfully so, it was taken out because it's impossible to go throughout our daily lives without referencing AI or using it. So I think that the one that I'd like to nominate to go into fintech jail is embedded finance. And the reason for that is because I believe it's one of those terms that started to be a bit stretched and a bit overused. Just because there's a widget in the bottom of a web browser or an app that takes you to another landing page doesn't necessarily mean it's embedded finance. It might be more of a hyperlink. And so I think that that's the one I would like to put into jail and ask the industry collectively, let's be a bit more diligent with what we call embedded finance and ensure that it is truly the spirit of offering and creating those integrated ecosystems between one provider as a marketplace and another. So I think that's the one I'd put in, Paul.
Excellent. Sounds great. Yeah, I'm more than happy to add embedded finance to the jail then this week, and we will see you later down the line if anyone wants to advocate to break that back out again. But for now, Seth, thank you so much again for joining us today. It's been a pleasure.
Thank you so much, Paul. Take care.
Well, that's all we have time for this week. Thanks, of course, to Seth for joining me. As for FinTech Futures, you can find us online at fintechfutures.com. And be sure to follow us on LinkedIn to keep up with the latest fintech news. If you like this podcast and our other episodes, you can subscribe on Apple Podcasts, Spotify, SoundCloud, or your favorite podcasting service to get notified about future episodes. Thanks as well to Arama for editing this podcast. You can check them out at arama.tv. As always, thank you very much for your support, and we'll see you soon for another episode of What the FinTech. But until then, goodbye.